Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Treasury yield curve is flashing a critical warning signal that's reshaping trading strategies across every major asset class. As of today, May 30th, 2026, we're looking at a two-year Treasury yield at 4.12%, the 10-year at 4.67%, and the 30-year at 5.18%. The yield curve inversion we're experiencing right now has historically preceded recession onsets within 18 to 92 weeks. That's actionable intelligence for positioning heading into the second half of 2026. Here's what's moved markets between now and Memorial Day week. According to Advisor Perspective's Treasury yield snapshot data, trader sentiment has undergone a dramatic reversal. Earlier this year, markets priced in multiple 25 basis point rate cuts based on core personal consumption expenditure readings that stayed near or below 3% throughout 2025. That narrative is dead. Markets are now pricing out near-term cuts entirely and even gaming the possibility of rate hikes. The catalyst for this shift ties directly to Federal Reserve leadership changes. Kevin Warsh's confirmation in May 2026 under the Trump administration has fundamentally altered the policy trajectory. We've moved from expectations of aggressive easing toward a neutral rate around 2.5 to 3% to a hawkish hold position with upside risk on rates. This isn't speculation. The Fed futures market is telegraphing this shift in real time. Let's break down what this means for equities first. Rising borrowing costs and higher discount rates are compressing valuations on growth stocks, particularly in technology and high-growth sectors. The math is simple. When you discount future cash flows at higher rates, present values decline. This has triggered a sector rotation into defensives that's accelerating. Utilities, consumer staples, and healthcare are outperforming as investors prioritize stable earnings profiles and dividend yields that look increasingly attractive relative to volatile growth names. The vulnerability sits squarely with high-debt companies and growth-oriented sectors. Any firm with significant refinancing needs in the next 12 to 18 months is facing materially higher borrowing costs. This isn't just a valuation headwind, it's a fundamental earnings risk as interest expenses climb. Traders need to scrutinize balance sheets and debt maturity schedules heading into Q3 earnings season. Fixed income is where the opportunity set gets interesting. According to Charles Schwab's 2026 outlook, high-quality investment-grade corporate bonds in the 2 to 10-year maturity range are offering attractive yields relative to their risk profiles. Institutional money is moving to lock in these elevated yields ahead of a potential economic slowdown. Credit spreads remain compressed despite rising base rates, which supports income generation strategies right now. But duration risk is the critical consideration. As reported by Penn Mutual Asset Management, the Treasury yield curve has both risen and flattened throughout 2026, creating yield volatility that punishes long-duration positions when rates move against you. The tactical play favors intermediate maturities where you can capture yield without excessive duration exposure. Some positioning in the 2 to 10-year range may be implicitly pricing in rate cut events for 2027, creating potential value for investors willing to extend duration selectively. Cryptocurrency markets are demonstrating zero decoupling from macro conditions despite the narrative around digital assets as uncorrelated hedges. Bitcoin recently dropped below $80,000, reflecting direct pressure from sustained Fed rate holds. According to data from Intellectia AI tracking Bitcoin's May 2026 performance, the correlation to traditional macro flows remains intact, particularly when central bank policy, Treasury yields, and dollar strength interact simultaneously. This matters for portfolio construction. If you're holding crypto as a hedge against traditional market risk, current price action shows that thesis isn't playing out. Bitcoin and major altcoins are trading like risk assets, not safe havens. The simpler framework: higher real rates pressure speculative assets with no cash flows. Until that dynamic shifts, crypto faces headwinds. Beyond domestic monetary policy, geopolitical factors are supporting higher long-term yields. Oil prices have surged over 50% since renewed conflict in Iran escalated. That's adding inflationary pressure and keeping upward pressure on the long end of the curve. Additionally, rising fiscal deficits and increased U.S. Treasury issuance are creating a supply-demand imbalance that supports higher yields independent of Fed policy. The combination of higher U.S. yields and hawkish Fed policy is strengthening the dollar, which has downstream implications for emerging market debt, commodity pricing, and multinational earnings. Companies with significant international revenue exposure face translation headwinds as the dollar appreciates. Now let's talk about the recession signal embedded in this yield curve. Historical analysis shows that inversions like what we're experiencing have preceded recessions within 18 to 92 weeks. That's a wide range, which means the inversion itself doesn't provide precise timing. But it does confirm that the risk-reward for economically sensitive positions has shifted. The Indiana Business Research Center's analysis of financial markets in 2026 highlights this inflection point as critical for portfolio positioning. What should traders watch heading into Q3? First, Federal Reserve futures pricing and any shifts in FOMC member communications. The market is currently pricing a hold or potential hike, but any dovish pivot would trigger rapid repositioning across asset classes. Second, Treasury yield movements, specifically the 10-2 spread duration and magnitude. A steepening curve would signal changing growth expectations and could reverse some of the defensive rotation we're seeing in equities. Third, corporate earnings guidance related to borrowing costs. Companies will start quantifying the impact of higher rates on their 2027 outlooks during Q3 earnings calls. That's where rubber meets road on whether this rate environment is sustainable or starts forcing economic slowdown. Fourth, cryptocurrency market behavior as a real-time gauge of risk appetite. If Bitcoin can't hold $80,000 with current volatility, it signals broader risk-off sentiment building. The strategic framework for this environment demands tactical flexibility. According to JP Morgan Asset Management's realistic surprise predictions for 2026, while some scenarios exist where gradual easing could eventually bring the 3-month rate to about 3.12% and the 10-year to around 3.75%, by year-end, current market sentiment points toward rate stability or higher rates in the immediate term. That means defensive positioning in equity allocations, quality focus in fixed income selections, and careful duration management in bond portfolios. The traditional 60-40 portfolio is getting stress tested in real time as both stocks and bonds face pressure from the same source: higher rates. Risk management becomes paramount when traditional correlations break down. We're at a juncture where yield curve inversion, hawkish Fed policy under new leadership, geopolitical tensions, and fiscal dynamics are converging simultaneously. That creates an environment where diversification may not provide the protection investors expect. The actionable takeaway: this isn't a market for complacency. The Treasury yield curve is delivering a clear message that warrants defensive positioning and heightened risk management. Growth to defensive sector rotation has momentum. Fixed income offers selective value in intermediate maturities for those willing to manage duration risk. And crypto remains correlated to macro flows, trading as a risk asset rather than a hedge. As we move through the second half of 2026, the intersection of monetary policy, fiscal dynamics, and geopolitical developments will continue driving volatility. The traders who adapt to this regime shift will find opportunities. Those who fight the Fed's hawkish pivot and ignore the yield curve signal risk being on the wrong side of a major market transition. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.